And we don't either. So basically, what we'd like to do is just say, well, let's videotape it. If they say good, we're golden there, then we can just post it. Otherwise, if they say no, like I said, we'll just kind of.
I'm gonna bet a lot of money on the fact that they're gonna say, yeah, no. And it might not, and it might be more LPL saying.
You know, we've gone both ways. So we've had others. You know, we had another like an MLP presentation. They said no problem too. So it's almost dependent on just the stuff.
I know they're finicky with non-training and stuff.
Exactly.
So yeah, whatever.
So
how do I
basically just
put this over?
Just put this on. You can just this is all ready to go.
Okay.
How about I walk you in here? We'll kind of just show you around.
Yeah. Forget his name. He showed me the
Chuck or Scott.
Scott showed me the remote thing. So
that is. There's no speakers in here.
So this is on.
Ready to go.
Okay.
Yep. So
okay.
So you don't have to do anything. You
okay.
just put it back there. We don't have any speakers in here, so that will not be amplified.
Okay.
Here. That's just for the video itself. And what you can do, you can see yourself up there. So as the video is progressing, it just picks up the lanyard right here, just kind of follows you around.
This is pretty cool.
Yeah.
So this will like.
Yeah. It tracks with you. It tracks the lanyard. So as
wow.
you're walking, just kind of keep facing this direction and always be.
Okay. So yeah, he showed me toggle down on the right side as the advance.
Do you like using this?
Yeah, I'll use that, and then if I have any issues, now that I know it's like this thing is pretty cool. I've never seen this big of a tablet.
Yeah, we do this for presentations.
Yeah.
So we'll pull up things right there in client meetings. So that's aspect to it.
That's awesome.
Move that out so you're not back here in the corner.
Good deal.
Yeah.
Awesome, man. How have you guys been?
Doing it.
It's good.
It's been really busy. We get some really good attendance to these workshops.
Yeah.
The reason why we do video recording is just for this reason, so they can't come here. They have the ability to watch them online. It gets good return value.
Hey, Sean. Long time no see.
Yeah. Thanks for coming in.
Yeah, you bet.
Nate's kind of brought you up to speed on the recording.
Yeah.
Stuff like
Yep.
that.
So we're ready to go there.
I didn't wear enough makeup today, so I don't know.
Too much, all right?
Well, I like how it moves back and forth. I've never seen that before. It's pretty
Don't
cool.
look up there.
Yeah,
Just
yeah.
Don't worry about that.
You're going to do the intro?
You can do the intro. Unless you have anything written down or anything?
No, I just whatever you want to. I didn't bring a bio or anything. If that's what you're asking.
Yeah.
I didn't. Just nod.
Let
Okay.
me go grab a little something. Let's talk for just 30 seconds before we start, so I can give you a good intro. Then.
Okay. You want to talk a little bit about upcoming workshops then too? Yeah, might as well.
I'm gonna grab another water. I'll be back. I guess. I can't say anything that's, too far over the line now.
We did a workshop on MLPs.
That's what Nate was saying.
Home office came out, so I've been kind of wondering if they were going to show up. Just
Oh, really?
Alternative investments are really. So yeah, I guess make sure you're following the robot today. Whenever that is.
Yeah. Yeah, it's pardon me.
So, give me the rundown.
If you want to know, let's see, I've been with Cole here since June, been in the wholesaling for what? 13 years doing this gig.
So, less than a year was Cole.
Been in the real estate world for 4 years. And have been doing this wholesaling racket for 13 years. Minnetonka. Yeah, I have one kid. Yeah, daughter.
Yeah, help yourselves to lunch and we'll get started here as soon as everybody's picked. Could you
is your daughter?
5 months. Yeah.
Congratulations.
Nice, man. Yeah, that's
My turn's a 1-year-old tomorrow.
okay. So it gets easier.
At 1 year old, he's the most independent person I've ever known.
Yeah.
And tells you exactly what's on his
Oh,
mind,
really?
and when
Yeah.
he wants it or doesn't want
There's
it,
no
and-
filter. Yeah. I'm starting to have like you can kind of tell their personality, you know, starts to come around, and I can tell she's gonna be pretty like just, you know.
You know, it all depends on, you know, I've seen some people, you know, daughters are actually easy comparatively to sons at this age.
Right.
Because, you know, they're just a little bit more laid back, this and that, but it all depends.
Yeah.
So there's never really a defining factor.
Yeah, she doesn't seem real laid back. She's always moving. Like her legs are always.
You know, probably get more and more.
Oh yeah.
Especially, you know, you're good when you can just sit in there and just
Yeah.
sit there and then you can walk away from it.
Right.
Just kind of look every once in a while.
Yeah.
The minute you start crawling,
Yeah. That's what everybody says. Yeah. Yeah. She's getting there. I think by Christmas she'll be crawling around for sure. So.
you basically contend with the fact that you have no idea how not baby-proofed your house is until
Right.
they start crawling.
Right.
And then
Yeah.
the minute they can start pulling themselves up, game's off. It's,
Yeah.
it's-
Yeah. That's what we're finding out.
so, well, good. Let's
Okay.
let the youngs get in, and let's kind of get started.
Okay. Oh, I know. Give you guys
Well,
each one of these.
How's everyone doing today? I like to hear that. It's a beautiful day. You got some great food, so what more do you want, right? There you go. Absolutely. We have a lot that we're going to be going over today. We're passing out some of the brochures that we're going to be going over. Those are going to be some of the handouts that do follow with the slides in a more abstract manner. We also gave you the handouts that will follow with the slides. So as you are listening, as you are kind of looking around here, take notes, because that is what's going to help you remember about all the ongoing of what we talked about today. And the reason why commercial real estate actually may be a very good piece of the pie for kind of your whole portfolio. So before we get started, before I introduce our speaker for today, I also wanted to make note of some of our upcoming workshops that we have here as well. Here at Summit Investment Advisors, we want to be really educational as what we are doing, the ways in which we are promoting all the ongoings of what it means to stay healthy, stay fit, but then have that lead into what the financial piece of the pie as well, to say, well, how do we work with mom and dad as they age? So we have an Alzheimer's workshop coming up here. That is on November 6th. So all the different details that are associated with Alzheimer's and how to deal with that. We also, coming up here, do have giving back to the community with respect to going to Feed My Starving Children. That is on the day after the Alzheimer's workshop, the 7th. If you would like to be a part of that, we're more than happy to have you, and that's just a great way to go pack some food for a lot of different children around the world. And the nice thing that is different about Feed My Starving Children than a lot of other organizations is they follow up with those children to actually make sure that they are getting the nutrients they need and not just giving them the food and leaving. So that's why we really like Feed My Starving Children and the way that they operate. Coming up for the last couple months, I should say, in 2014, we also have one called Grandma Was Right. Now, she was right about a lot of things. I know, at least my grandmother was, but one of the things that she was right about that pertains financially was dividends. That she was right in saying, well, those utility companies that pay some dividends, those are really good ones to have. Or other stocks that are out there that pay dividends, those were great stocks to own over the course of years. And it turns out they still are. So we're going to be discussing just all the ongoings about the way that Grandma was right. And then we also have another one coming up here on the reasons that being an organ donor is really, really kind of a great feel for not yourself, but also a way to help others as well. And we do have a gentleman coming in that his into your portfolios, and especially what we have up here, the net lease advantage. So he's going to explain all of this to you, just the best ways in which it fits in, and the ways that it helps to make dividends happen, distributions happen in your portfolio, and actually possibly remove some of that money out of the stock market so we don't see emotion, ups and downs of the stock market. And that's what I think all of you are here to try to avoid some of those huge gains. So Jason is just a great resident of the Twin Cities here, lives in Minnetonka, has a wife and you say a 6-month-old baby
Yeah,
girl?
just about, yeah.
I was telling him I have a year-old son, and the sleep never gets better over the course of that time, so there's a lot to look forward to.
Yeah.
He's been with Cole Capital for just under a year now, and has been talking with all the different real estate world for over 4 years, so he has some great experience as to how this pertains to your portfolios and the way in which we can actually use them to be a different part of diversification. So with that, please put your hands together for Jason Johnson.
Thanks. Thanks, Nate. Well, we'll keep this pretty informal. So for those of you who are a little bit new to this, feel free to ask any questions along the way. This isn't meant to be that I'm the big authority up here just because I've got this microphone and all this stuff going on. We'll keep this fun and entertaining. As Nate said, I live over on the west side of town. I actually grew up in Hector, Minnesota, and there's a free golf shirt in here if you can tell me where Hector is.
It's out of western Minnesota, and Hutchinson, and it's on 212.
There you go. You nailed it. Okay. See, most people have no idea, so we'll get you taken care of afterward. Growing up out that way, there's a lot of things that, coming from a small town, actually grew up on a farm, that when you look at commercial real estate, there's a lot of different commercial real estate that's out there. Out that way, the biggest type of real estate is land. As you've probably seen here in recent years, that's gotten more expensive. Obviously, what you would want to invest in, if you're going to invest in commercial real estate, more than likely is going to be something that's going to generate income. And what we're going to talk about today is a particular type of commercial real estate called net lease real estate, which means we're looking for 3 very simple things. We want a long-term lease, we want a net lease, and I'll explain what that is in a second, 100% occupancy in a net lease, by the way, to one tenant. And some of you looked at the brochures there that kind of looks at who the types of tenants are. You see a picture of Walgreens. That's a great example of some of the things that we buy. And the third thing, as I alluded to Walgreens, is we want a big investment grade, well-known type of a tenant. We don't want a nail salon or a tanning salon or a sandwich shop to be the tenant that we have in the building. We want a Walgreens, a Home Depot, an Amazon, that type of a tenant. So that's kind of what we invest in. There's a lot of different types of commercial real estate. First, I should ask, does anybody in here own any real estate outside of any type of real estate investment trust? Do you own an apartment or a duplex or anything like that? So those are more of your, kind of the other side of the equation, where you have a 1-year lease from a individual type of a tenant, where we want a long-term lease from a big, well-known type of a tenant. There's no right or wrong, good or bad type of real estate. A lot of this has to do with timing and the cyclicality of the market. And this may or may not be something that you're interested in. And the best people to talk to are, in the back of the room. Sean and Nate can tell you, you might be interested in this, and I might tell you, no, this doesn't make any sense for you. I assume since they invited you to be here today that this is probably something they thought you might be interested in. But this is not meant to be a sales pitch. This is just more informational. We are going to talk a little bit specifically about today what net lease real estate is. First, I'm going to talk about who Cole is. Cole has been around since 1979. That's a company I work for, just so you guys are aware. Cole Capital has been buying this type of real estate, net lease, investment grade commercial real estate, since 1979. So from really the early 80s or late 70s through today, this is all Cole has ever done. We've never been buying apartments. We've never been buying, big multiple tenant office buildings. We've never been buying, hotels. That's just not what we do. Everything that Cole has done has always been the same criteria, 100% occupied by one tenant, that's a big name tenant for a long time and really looking for consistency and dependability of, first and foremost, the income check. So without asking in the room here how many people are going to be looking at starting to depend upon their savings for retirement income sometime in the near future, I'm going to guess that a good amount of you are at least somewhere in the vicinity of thinking about how much can I actually generate from my retirement, my savings, my IRA, whatever it may be, to give me some type of dependable income in retirement. And that's really what we're going to talk about. What the consistency is here is you have, again, a big investment grade tenant that's going to pay the rent for the next 15 years in these types of properties. There's going to be very little deviation from year to year, month to month in terms of the income. And that's the number one objective in everything that we do is consistency of cash flow from the tenants. Has anybody in here ever seen the movie Happy Gilmore before? Or familiar with what I'm talking about? There's this Adam Sandler comedy movie where some hockey player that tries to convert to be a golfer, and he goes out and he's hitting 400-yard drives. It's fiction, by the way. It's not a real movie. It's basically he runs up and he does kind of a crow hop, and then he tries to take a step and hits the ball 400 yards off the tee, and it's kind of this comedy mythical about trying to hit the ball a little bit further. And the thing about this is, if you think about, for those of you who are familiar with the golf world, the golfers that are the best, the highest ranked golfers, whether it's, I think right now Rory McIlroy is the #1 ranked golfer in the world, if I'm not mistaken. I haven't, with the 6-month-old, I haven't had a lot of time for sports or golf myself, so I could be mistaken. But the highest ranked golfer at any given time is going to be the most consistent golfer. The most consistent golfer has one thing, and that's always going to be the case from year to year, from golfer to golfer, is that they have the fewest amount of moving parts. Now, if you've ever seen Jim Furyk swing a golf club, you know that doesn't always hold true. For those of you who don't know, you can Google it, and he's got this weird golf swing. But for the most part, when people are golfing, it's a very simple takeaway and a very simple follow-through. They're the most consistent. Now, obviously, for those of you who have tried to do this, it's easier said than done, myself included. But when you look at what we're doing is we invest in what is the most consistent income type of property and also the most consistent outcome type of property, because what we invest in is going to be very few moving parts. We want, again, no vacancy when we buy a building. We're not trying to buy something that's half empty and then put a bunch of tenants in there and flip it and try to get a big premium for it. There's a lot of risk that goes into something like that. We want nothing to do with that. And there are companies that do that much better than we do. That's what we'll let them do that all day long. Our strategy is very simple. We want one tenant, long lease, 100% occupancy. So we have the most with net lease real estate, and Cole is not the only company that does this. There are other real estate investment trust companies that do net lease real estate. We have the most consistent strategy in the real estate world. There are other types of real estate where you can have more moving parts and get more upside potentially. That's fine. We're never going to be the big flashy company. It's going to be kind of boring. But what we're looking at is that consistency of that cash flow and the durability of the income. So kind of move along here. If I can get this, I'm just going to use this. Oh, that's not working either. Okay.
It's one bad aspect of technology is that it times out every once in a while.
All right. You should read this. All right, okay. So, and everybody has a copy of the PowerPoint presentation, so if there's anything you have questions on, just jot a note down or ask me, and if there's something you want to stick around afterward and ask me, I'll stick around. So what is net lease real estate? I've said this probably a dozen times already. What net lease real estate is, as opposed to gross lease real estate or managed income real estate, net lease real estate is real estate where the tenant is going to pay the landlord, in this case Cole would be the landlord, the rent on the property, and the tenant is going to be also taking care of the maintenance on the property, the taxes on the property, and the insurance on the property. So it's called triple net, or net of insurance, net of maintenance, and net of taxes, net, net, net. So they're going to pay us the rent, and then they're also going to take care of their own building. So now what this means for us is there's very little upside or deviation from or downside in terms of what we're going to be looking at from the cash flow standpoint. We're not buying these properties with X amount of cash flow and trying to get that cash flow to double. That's just not what this is. It's basically, it's a full building, one tenant. They pay all the snow removal, and they fix the facade on the Walgreens store, and they fix their parking lot if it needs to be fixed, and they pay the taxes and they pay the insurance on the property. We're looking at this purely as an income play, and at some point we want to be able to monetize and liquidate these assets to deliver your principal plus some gains back to you as a shareholder. So that's the strategy. Really the word to think about here is predictable. The only way that we do not get paid is if the tenant, and by the way, the only way we do not get paid the rent, I should say, is if the tenant goes bankrupt or defaults. This can happen. In the past, Cole has owned a couple of the Borders bookstores, the Circuit Cities, and the Linens and Things that have actually gone bankrupt. It does happen. At that point, I think in that, the particular offering that we had open in 2006, 7, and 8 that actually invested in some of those properties, it amounted to 4% of that particular portfolio. What happens in that case is we then have to go back and find a new tenant that can release and take that space. Somebody told me around here there was a Circuit City that turned into a gym or something like that. So, that's the type of thing that happened with those. We had to go back and find a tenant that would take that space. It was obviously not going to be another Circuit City because they're done. So it's up to us to go find somebody else to repurpose that property and get the cash flow going back into the building. So that's what we're investing in. The real risk, the main risk is default by the tenant. And obviously that's a big part of our due diligence on who the tenants are. We're not going to look as much at the property. A Walgreens is a Walgreens is a Walgreens. Walgreens does a great job as a builder of their property. They do a ton of research on the demographics of the area. Do we build the Walgreens on the north side of the street or the south side of the street? Do we want to catch people coming home from work or going to work? They know all that stuff inside out, backwards and forwards. We let them do the due diligence on where they want to build the property, and then we may or may not want to be interested in buying those properties from them from time to time. So that's the net lease strategy. We're going to talk a little bit why you would invest in commercial real estate. First and foremost here, really if you think about last week, how many people in here were watching CNBC last Tuesday, Wednesday, Thursday, Friday saying, man, I've got kind of a cough, do I have Ebola, or, what's going on with, this, that, or the other thing in terms of just the overall stock market if you were watching CNBC or, I'm in my car driving around quite a bit. I listen to it on the radio, and of course they generate ratings by making, creating some type of chaos by the headline. The Dow is down 1.5%. Well, what does that mean to you? Probably nothing. It's probably back where it was last week. You didn't really lose anything from week to week. But over time, it's 2008, 2009 are a great example where obviously there's some emotion that gets in investing, and I'm sure you maybe had some conversations with Nate and Sean about, do I sell, do I stay in, should we take some of the money off the table, what should we do? And hopefully you stayed in the market and rode the storm, but a lot of people needed the money or were afraid of what could happen, so they took some of the money off the table and sold out of the market. Meanwhile, in the last 3 or about 5 years, we've had about a triple in the S&P 500. So fear and greed are the two emotions that rule investing. What we're going to talk about here is that we're going to take statistically some of the fear and greed off the table by having some illiquidity and buying commercial real estate. By its nature, it's not meant to be bought today and sold tomorrow. If you buy a building today, you're not going to sell it tomorrow. You can buy a stock today and sell it tomorrow, or a mutual fund today and sell it tomorrow. Real estate, the number one thing that you have to consider is that it is going to be illiquid. You may have a time frame of as long as 5 to 10 years. If things don't work out, this could be a long hold. We've seen shorter cycles in the liquidity events in recent years, but that is the number one thing to be concerned about in terms of when you invest in commercial real estate. So if you look at where this fits, there are two risks that you have in the market today. If you look at the equities market, the risk is the volatility, right? If you retire at the wrong day or the wrong time and you have, 2008, 2009 scenario affect your portfolio, and all of a sudden you're left with, as it was a 57% downturn in 2008, in 2009 from peak to trough for the S&P 500. If you're retired in the beginning of 2008, you lost 57% of your value 1 year into your retirement. We don't want that to happen. Obviously, we want to try to find some ways to temper the downturn, mitigate the risk to the downside by having some of the valuations in this be consistent. The other side of this is you look at the fixed income market. The fixed income market has its own risk right now if interest rates start to rise. As we all predict that they are going to have to at some point, interest rates will have to move upward. That's going to have a negative impact on the underlying value of your bond portfolio. So where do we go to try to find something that's going to mitigate the risk of both the equities and the fixed income market that can give us the yield that a fixed income position or a bond portfolio would give us, that's going to give us the upside and the equity participation that stocks might, or an equity mutual fund might give you. That's what this is meant to be. So moving ahead, the number one thing I've been talking about here is where commercial real estate fits is we want to have something that's going to give you current income. Income is the number one objective for why people would invest in commercial real estate. If you're not taking the income, the rent checks that you would get, in this case, it's called a dividend or a distribution that comes to you in the real estate investment trust, is going to help actually add to the value of your portfolio if you want to just let the shares accumulate. Capital appreciation, we hope to sell the properties that we're buying today for more than we get out of them more than we put into them. We want to have some growth in the property value. An inflation hedge, if you think about why you have inflation, interest rates and inflation don't just happen in a vacuum. Inflation happens because there's more money that's being spent. There's more profitability for corporations or for people that are out there earning money. They have more money to spend on goods and services, means that values of land, commodities, all the things that go into real estate go up. So today it may cost us, for the Walgreens store, $5 million. In 10 years, it might cost us $7.5, maybe it's $10 million, I don't know. But it's not that so much dependent upon the Walgreens profitability. It's going to depend upon, the value of the land. The land is going to continue to go up, assuming that there's commerce going on and there's value to that property. The value of the commodities are going to go up. The bricks and mortar and whatever goes into building that property going to go up. So this acts as an inflation hedge. So if we buy something today, we would hope that if things work the way we think they're going to work, that we'll be able to get more than what we put into the building. So it gives you a hedge on the dollars that you invest. Lower volatility, again, last week is a great example. The value of the stores that we have or the office buildings that we own, in theory, they change from day to day. But you're not going to see them move 350 points like the Dow did, last week. That just doesn't happen. You're going to have a very slow and meandering change to the value of the commercial real estate, and over time, hopefully, we're going more up than down. And managed portfolio risk, again, it's something that is not directly correlated with the stock market. And we'll talk about that coming up here a little bit. There's a couple of statistics that talk about this. So, as a source of income, we look back, the 80s, you had higher interest rates, and obviously one of the things that you see here is as time has gone on, we really have the death of yield is the easiest way to say this. If you look in, I'm sure that if you ever walked into the bank, you look and see what's the CD rate. Everybody in the last few years has learned a new term. It's called basis points. It used to be, if it's 5% for the yield on a CD, now it's 25 basis points. It's 1/4%. And you can do your own rule of 72 on 25 basis points and find out how long it takes you to double your money at 25 basis points. It's a long time. So people are looking for something that's going to supplement or augment the income that they have in retirement or pre-retirement to try to give you some total return that's not directly correlated to the market. That's what this does. And even with the big downturn in interest rates on all the other, T-bills and stock dividends and the Barclays bond index, you can see commercial real estate, even in the last few years, is still well above 6%. Now, both of the offerings that we have pay a monthly distribution equivalent to 6.3% annually. That's kind of in the industry with the real estate investment trusts that are out there. You're going to be somewhere in the mid-6s for different types of commercial real estate. So the yield has stayed pretty consistent with real estate. So we look at you know, what's going to give you the biggest part of the total return? With commercial real estate, about 68% of your total return is derived, is the word I'm looking for, from the yield that you would get. So the way to say this is if you invest $10,000 and you're going to get 6% annualized income from that real estate investment trust, and you have a 10% total return, the other 4% came from, you got a 4% annual increase on the value of your $10,000. So, let's call it 1 year you sold for $10,400. That's the total return strategy that we're looking for, but the vast majority of the return is going to come from the yield or the dividend or the distribution, whatever we call it, that's translated from the rent check that comes from the tenant. Looking at this, the correlation of total returns with inflation. Real estate is the one thing that keeps up with inflation better than any other type of investment that's out there. And it goes back to what goes into real estate? Well, it's the land, it's the bricks and mortar, it's all the commodities, and it's obviously the cash flow. As the tenant that's in the building has more wherewithal to pay more rent, we are a pretty good steward of the building. We're going to go in there and ask them to pay more rent if they have more profitability. That's the nature of being the landlord. Standard deviation, basically, how correlated and how volatile is the commercial real estate. Much lower. It's about a third of what you're going to see, not quite let's call it about 40% of the standard deviation of the stock market. Means you have much less volatility in commercial real estate with a very similar long-term total return, which I think is one of the charts that are coming up here. The correlation. So last week is a great example of lack of correlation. Commercial real estate is going to be about, as I think it's, where's it on here? As it's correlated to the overall market, 27% or 0.27%. So basically you have about a quarter of the movement in the day-to-day, month to month and year to year volatility of the equity market or large listed REITs and large stocks you're going to have in the commercial real estate market. Actually has a negative correlation to bonds. The reason that is that when interest rates go up, bonds are impaired. Actually, you lose value if interest rates rise in the value of your bond. With real estate, if interest rates go up, you actually gain more of a total return. If interest rates are rising, going back to the inflation doesn't happen in a vacuum. Inflation happens because, again, there's more profitability from the tenant. The value of the land is worth more. The value of the commodities that go into building a new building are cost more. So with respect to rising interest rates, it's actually going to hamper your bond position, and it's going to give you, in theory, a rising value of your commercial real estate position. So they kind of are good, yin and yang, so to speak, in terms of your portfolio. This is why we've seen so many investors, not just from the yield perspective, because you can get a greater yield than most of the bonds that are out there, bond positions, but also to protect against the downside of a rising interest rate environment to transition some of the assets that they have to commercial real estate. Hypothetical portfolio, looking at 20% of your portfolio in commercial real estate. This I'm going to skip because this is up to you and whoever you work with, Sean or Nate or whoever, to decide how much is right for you. The limit, I think, that most compliance departments will even allow you to invest in commercial real estate is 20%. And I'm basically what the gist of the slide here is that if you put some alternative and direct investment positions inside of your portfolio, you greatly reduce the volatility and the standard deviation and the correlation of your portfolio to the overall equity market. And again, last week is a great example. If you were 100% in equities last week, you saw some huge swings in your overall portfolio value. If you throw in a little bit of bonds and a little bit of commercial real estate, you mute a lot of that ups and downs in the commercial real and the value of your portfolio. Again, this isn't for us to decide. This is for you when you sit down and put together a plan for your retirement or savings or whatever it is, for you to sit down and decide for yourself. Read that. So we're going to talk a little bit about REITs. Now, how many people in here already own a real estate investment trust in some way, shape, or form? So a good amount of you already have some experience in dealing with this. How many people in here own a Cole real estate investment trust? So, okay, good. So you guys are already kind of familiar with the story and the strategy. And for those of you who are not, again, feel free to ask questions. So far, so good. Are we doing okay? For those of you who own Cole? Okay. Yeah, Cole is, and I didn't spend a lot of time on this because I'm not trying to do this as a sales presentation, but through good markets and bad, because of the strategy, long-term leases from a big tenant, there's not going to be a lot of volatility in the value of what we do. Real estate has a lot of different sectors, and again, what we do is a very, very boring, very consistent type of a strategy. So if you look at the traded REIT or the listed REIT market, listed REITs are also investing in commercial real estate. The advantage that a listed REIT is going to give you is that you have daily liquidity. You can trade a listed REIT just like a stock. It is a stock basically. With a non-listed REIT, what we have with Cole, you can't do that. If you invest some of your assets into Cole, we have some redemption procedures, but it's really not meant to be sold out. This should be your long-term investment money, so money that you can leave untouched for 5 to 10 years if need be. What our objective again is to derive income from the real estate, from the tenants, to take the rent that they pay us and then put that either buy more shares by reinvesting or to send that check to your mailbox or do a direct deposit, whatever it is. A listed REIT, the benefit again is that it's liquid. Now, last week, what's good, what's better, what's worse? How many people want to have daily volatility of as much as 5% in a listed REIT versus a non-listed REIT where you have very little volatility? And this is really and I'm not saying you shouldn't do one or the other. For most of the people that I see, they have some position in both a listed REIT and a non-listed REIT. And again, the biggest objective, the biggest thing to overcome here is that you are going to have a lack of liquidity with a non-traded REIT. So the benefit is usually with the lack of liquidity, the return you get is sometimes it actually benefits you. Again, sometimes you want to sell, but you can't. So it takes the emotion out of the fear and greed off the table because well, maybe I should have sold that real estate. Well, it's illiquid. We can't go sell shares of that just to give you your check back because then we'd have to go start selling commercial real estate until the portfolio is ready to be liquidated as a whole. Usually it doesn't work very well for us to do that. So that's the number one objection that people have to this is that it is illiquid. If you have the wherewithal, the time frame that you can have some of these dollars set aside for a long-term piece of your portfolio, that's where it fits. In return, you usually get a little bit higher yield in terms of what the non-listed REITs are going to pay you versus the listed REITs. Not always the case, but usually the yield, in this case it's 6.3% with Cole on a monthly basis. The listed REITs are usually going to be somewhere a little bit less than that, so you get a bit higher total return in that time frame. So how does this work? What's the process from start to finish? So if you sit down with Sean or Nate or whoever you work with here, you decide that yes, this is something that we should implement as part of the plan. It makes sense. It's going to give us income we need for retirement, or it's going to give us lack of correlation to the market. You write a check to Cole. We're going to take those dollars. It's just like a giant mutual fund of commercial real estate. So we have the check that you send us plus all the other thousands of investors that are in the pool with you. And we're going to raise, for the current offerings that we have, it's $2.5 billion each. So pretty big amount of equity that we're going to raise. With the Cole Credit Property Trust 5, which is the necessity retail, the one with the Walgreens on the front of the brochure, we will probably have somewhere in the neighborhood of 400 properties, give or take, around the country. It's all domestic. So it's a pretty well diversified in terms of tenant and location and everything. In the office and industrial REIT that we have, where it's buying corporate headquarters and Amazon distribution centers and warehouses and things like that, those properties are a little more expensive. So we're probably going to have maybe 75 to 100 properties there. We're going to go buy those properties as we have the dollars come in. So right now we have a big pipeline in both of the offerings that we have open of about, $400 to $500 million a piece that say, okay, when the dollars come in, we're going to close on this property next. When the dollars come in, we want to have these dollars be implemented right away, because we don't make any money for you if we just sit on cash. And if we're trying to pay 6.3%, we have to employ those dollars and invest those dollars as fast as possible so that those tenants can then turn around and pay us rent, and we can send you that back in the form of a dividend. So we're going to go buy properties, and then I kind of jumped ahead here. The tenant's going to pay rent, and these are all contractual obligations from the tenant. So what happens here is this is essentially an account payable from the tenant. And I'm not going to go through the whole accounting standards, but basically accounts payable is senior to dividends paid to common stock shareholders and preferred stock shareholders and the interest paid on debt. So we get paid before the debtor, the bondholders get paid, the common stock shareholders get paid, and even the preferred stock shareholders gets paid. The only way we don't get paid again for the rent is if these tenants go bankrupt, which again is a possibility. If they decide to close down the store, if they decide, as Walgreens has done and as Starbucks has done in some of our portfolios in the past, these 10 stores that you guys own with Cole, we're going to shut them down. What happens is they have a contractual obligation with us that they are going to pay the rent. It may not work for them to have the building in, Hugo. Anybody from Hugo? I'm just picking a store or a town that's kind of out on the periphery here. Or Hector, where I come from. I know there's no Walgreens or Starbucks in Hector, I can promise you that. All of a sudden, the business isn't strong enough to have that store open. It's their obligation to pay us the rent, so the cash flow continues to go to you as a shareholder in the form of a dividend. Now, they want to go back and find somebody, there's some way that they can repurpose that property, maybe sublease it, but we're not worried about that. It's the tenant's responsibility. So then we're going to pay you the dividend. So what happens here is as the REIT gets fully invested in both of these offerings that we have right now, we're going to be raising money for probably the next, I'd say through the middle part of next year. No more than a year from today, both of these offerings will be fully subscribed and will be done accepting dollars from investors to invest in the current funds, and we'll go on to the next fund. From the time we stop raising money, there's going to be a management period where we get all the dollars invested, and we want to go back out and essentially we want to start to go find a buyer for these 400 retail stores or these 75 or 100 office and industrial buildings that we have in either of these portfolios. Now, that might take a year, that might take 3 years, it might take 5 years. It just kind of depends upon the environment that we're in at the time. We've had some in the past where we bought properties in 2006, 7, and 8. It took us about 7 years from start to finish for that offering to liquidate the assets because we had to let the market recover. 2009 was not a good time to try to liquidate anything. There was just nobody that was going to buy that portfolio. So it took us about 7 years. The one that we bought from 2009 through 2012, from the time it closed, it took us about 14 months before we had the dollars listed on the exchange, and that was the Cole Credit Property Trust 3 that some of you may have owned. And then Cole 4, that closed in February of this year. It may be next year. I don't know. We don't have any real direction on that one, but point being is it just kind of depends upon the market conditions in terms of the timing that you're going to have that liquidated. In the meantime, you're going to continue to receive that dividend or rent check that's going to be paid to you on a monthly basis. So that's the consistency. That's going to be the thing you'll see from month to month. That's really not going to deviate a whole lot. Then when we look at as a liquidity event, we're more than likely going to be merging the portfolio into another traded REIT. It may be sold to an institutional fund. In some way, shape, or form, the liquidity event means that those shares that you invested in now become liquid either through a stock exchange merger with another traded REIT or some other public entity, or to be sold to, as I said, a big institutional investor where you would have your shares be liquidated. Any questions on how that works so far? And again, this is the biggest wild card because it could be soon, it could be 5 years, it could be 10 years. Nobody knows how long the dollars are going to take to be liquidated.
What do people typically get when it reaches?
Sure. And that's a good question. So obviously we want to get you a premium on the sale. So if you bought at $10 a share, we want to get you something greater than $10 a share. And the way Cole works and where we're incentivized is we have an alignment with the shareholder in that what's called a preferred return, or a subordinate return of, we have to earn the shareholder either 6 or 8% per year, and it depends upon what offering you're in. Some of them have a 6% hurdle, and some have an 8% hurdle. But essentially, we need to earn you not just the dividend, but also some total return, some appreciation on the share value in addition to the yield that you got before we make any money on the back end. We're really the fee that we're after is it's on the back end. It's an incentive fee where we would participate in some of the equity return on the back end. So anything above an 8% return, as an example, would go 85% to the shareholder and 15% to Cole. So we have to earn you your principal, your yield, plus an 8% annual total return before we participate on the back end. And obviously, we want to build the best portfolio on the front end that we possibly can. And also we want to liquidate as soon as we can at a favorable price, because every year we delay, we have to earn another 8% per annum. So if it takes us 10 years, we need to earn you 80%. Well, the further we go along, the further the goalpost gets moved in terms of that hurdle rate that we have to earn for you as a shareholder. So that's a good question. We're not just going to liquidate the fund just for liquidity's sake. We want to have a positive total return. We actually depend upon, for the profitability of the company, to have a positive total return for the investor in addition to the yield that they had. Any other questions? All right, so we're going to talk now just a little bit about the two offerings, and I think there's just one more. Actually, I'm going to cover this first, the tax piece. So, it's about half the money that we get is non-qualified when people invest with us. The other half is going to be IRA money, Roth money, whatever it may be. Obviously, if it's an IRA, any dollars that come out are going to be fully taxable in terms of the gain that come out. If it's a Roth, it's all income tax free, after tax dollars. So for the non-qualified dollars, if you have $50,000 that you invest that just came from non-IRA, non-Roth type money, that's just in a cash or mutual fund account, a brokerage account, and you invest that in here, what's going to happen is you're going to actually have some tax advantaged, the capability of having some tax advantaged income. You're still going to pay tax on this. Trust me, the old saying, death and taxes. It's not like you avoid tax. It's just that you change the tax rate for yourself. So what happens is when in this case, it's a $100,000 investment, and this person owned this for the entire calendar year of 2014, and they're in the highest tax bracket, or one of the highest tax brackets, 39.6%, and we're just going to go for a straight 6% yield to keep this very simple. So we're going to assume, and we never know until the end of the year how much of this is actually going to be depreciated, but we're going to assume for the purpose of this illustration that 50% of the yield, the $6,000 on the 100, is depreciated. So whenever you buy real estate, with the accounting rules, which I'm not going to get into accounting here at all, not my area of expertise, but just to talk about this very high level, is that you are going to pay income tax on the distribution that comes out of this if it's non-qualified. If it's brokerage account money that goes into this, you're going to pay tax on it. What happens is you also get to depreciate out of that income the real estate, the value of the land, the value of the property, etc. You get to depreciate that over a certain amount of years. And there's no guarantee that it's going to be 50, but what we've seen historically speaking is that it's been about 50% of the yield that you receive is going to be depreciated, meaning you don't pay tax on it for that calendar year. So in this case, the person got a $6,000 check from their dividend for the yield from their distribution from their REIT. They only pay tax on $3,000. So what happens to the other $3,000? You're reducing the basis of your remaining assets. So you are going to pay tax on it down the road, but you're not going to pay income tax on it. You're going to pay capital gains tax. So if you have $100,000, you got a check for $6,000, $3,000 of it was income taxable at 39.6% plus whatever we pay here in Minnesota. Big numbers. The other half is going to come out of there without tax. So then the $100,000 basis, let's just say you sold this next year for, I'm going to use the number of $110,000. We created a liquidity event where you deliver the principal back to you. Your selling price, let's say it was 110, you had a 10% premium on the value. As an example, your basis would now be $97,000, right? Because $3,000 of it was reduced from the depreciation. Now you have a taxable long-term capital gains taxable event of $13,000 instead of the $10,000 that you would have had without the reduction of your basis. So really what's happening to kind of make this simple is you're trading ordinary income tax today for long-term capital gain tax tomorrow without getting into where you're at in your own personal tax bracket. Hopefully, the ordinary income tax versus the long-term capital gains tax, and this depends upon your personal situation, whether you want to use non-qualified or qualified dollars. More than likely, you're going to have a higher personal income tax bracket than you are long-term capital gains tax, without getting into too many muddy waters about taxes. Go ahead.
Earlier you mentioned that you've got this yield coming in and you can opt to take it as
Yep.
cash, or you can leave it to be reinvested.
Yep.
What happens if you leave it to be reinvested?
It's a good question. So if you reinvest, and thanks for bringing that up. So if you, in this case, let's say you didn't take this $6,000 in this example and you just reinvested it back into the fund because you don't need the income yet, maybe you're still working or you've got other sources of income in retirement and you just want to build this account value up. What happens is when you reinvest back into the fund, you actually, you have what's called a dividend reinvestment plan where you can reinvest in the fund at a 5% discount. So if shares are offered at a $10 share price today, and you get a 6% distribution on that, part of the incentive to reinvest back into the fund is in this case, $6,000 would be reinvested back into the fund at a $9.50 per share price. Now those new shares that you buy are also generating 6%, so it just, it's a way to build your account value. Now, great when the market goes up, not so great when the value of the shares goes down. If the value of the shares goes down, you own more shares that are worth less, and and it's up to you to decide how you want to do it.
What does it do in terms of that tax?
So if it was non-qualified, that's a good question. You still, even if you're reinvesting, it's still income that's paid to you. So you still would pay ordinary income tax, in this case on the $3,000, even though you're going right back into the fund with it. And again, that's for you to sit down and figure out for your personal situation. You can change it anytime you want. You can mix it up. So you can say, I want half the money in direct deposit to my checking account the first of every month, and I want the other half to go back into more shares. And you can make that decision on a monthly basis if you want. Most people just kind of set it and leave it and never think about it. But it's, definitely something that, depending upon your tax situation, may or may not have big consequences. Any other questions?
So when the value of your shares changes, does your percentage stay with your original investment?
Yeah. Yep, so that's a good question. Now, first of all, the dividends are not guaranteed. This is not an insurance product or a bond or anything like that where those income streams would be guaranteed based on the full faith and credit of the insurance company or the bond payer or owner, or seller, I should say. In this case, the income it can vary from month to month, from quarter to quarter. Historically, this has been pretty consistent. That really hasn't moved a lot because these are all, again, long-term leases that don't really, we're not going to change the structure of the lease. So if let's say the price of the real estate goes from, on an appraisal basis, which may happen, could go from $10 down to $9 a share. Now, if the income is still there, let's say in this case it's on a $10 purchase price, 6%, it'd be 60 cents. If the income is still there, even though the value of the real estate has gone down, because let's say it's a 2008 or 9 situation where the value of everything got reduced, but the income didn't really change for many of those tenants, assuming we had very few of them or none of them go bankrupt. The income is still going to be, assuming that not a lot has changed, 60 cents. And it may deviate a little bit, but it's still going to be 60 cents. So,
So when you get your statement, is it gonna say 6% or is it gonna say a higher percentage because the value?
yeah, I think on our statements, and I haven't seen one recently, I think it may just say this, the cents per share that you get for the, I don't think we quote a percent. But yeah, so obviously the math would be greater based on a lower share price. But yeah, our number one objective is, regardless of what happens to the share price up or down, is consistency of the cash flow, and that's what holds the, maintains the value of the real estate. Any other questions? All right, I'm I'm just gonna skip right ahead to the end here. Core, what we talk about in commercial real estate, there are lots of different types of commercial real estate. Today we're talking about net lease real estate, and we really consider this in the word that's used in the commercial real estate world is core. So what does core mean? Core means you have, as it talks about here, the tenant. I talked about big name tenants like Walgreens and Amazon. It says national industry leading corporations, creditworthy, a focus on investment grade tenants and financially strong tenants with proven track records. We don't want some new startup tenant, some .com type tenant that just developed an app or something like that and just came out of the blue. We're probably not going to have them as a tenant. They may be the greatest thing since sliced bread on your iPhone or whatever, but they've been around for 6 months and they have no business track record, and if the next big app comes along, they could be wiped out. That's probably not where we're going to go with the types of tenants that we're going to be investing in. It is going to be the bigger, well-known, longer-term names that have been out there for quite a while. Corporate-backed leases, as I said, the tenant, as I said before, is responsible for taxes and maintenance, and we're going to look at long-term leases. We don't want a 5-year lease or 3-year lease. The risk is we get to the end of that lease duration and all of a sudden the market's down and not a good time to be a landlord. We don't want that release risk at all. That's 100% taken off the table from everything that we're doing when we sign the lease with these tenants. We want 10 plus years, and we're going to try to skew it toward 15 years for the tenants. And again, strategically located, newer construction, and currently generating income. So we're never going to be developing new property, doing development deals with the dollars that people invest with us. We want a building that's already in existence, that's already 100% occupied by the big name tenant, and we're just going to free up their capital by buying it from them. They like it because they can take their $5 million from Walgreens and go build the next Walgreens. It frees up assets for them. We're looking at that, and the strategically located. As I said before, all these tenants have some pretty good demographic studies that they do. What side of the street do you build on? What suburb should we build in? What neighborhood should we build in? They do all that. We look at, okay, do we want to buy in that neighborhood? Do we want to buy in that neighborhood? We'll pick and choose which ones we want to buy. And we're going to buy, by the way, mostly in the middle of the United States, as I like to call it. We're not going to buy Manhattan. We're not going to buy San Francisco. We're not going to buy Orange County or Miami. Nothing against any of those places. They're all beautiful, but they're all very, very expensive. And it makes it very difficult for us to generate the appropriate amount of yield to pay the 6.3% monthly distribution. So it's going to be great cities like Minneapolis that have very low unemployment. Texas is another great example. We own a lot of stuff in North Dakota, believe it or not. The middle of the country is what we like to call it, where all the smart people are. So, moving on, I think there's just a couple slides left, and now I think this is frozen up again.
No, actually, it's the last.
That's it. Oh, there's no, okay. I thought there were supposed to be a couple more slides. So, last, I guess I'll just stop there and I'll explain, I ran out of these, so I've got one more here to give to the people in the back of the room. This is a pretty good example of what, okay, that's fine. And you can have that one, just that amount of these. This is a pretty good example of what's in the portfolio that we currently own. This is from the end of the second quarter. It says we have 7 properties. I'll tell you at the end of the third quarter, we're up to, I think it's 47 properties or 49, I forget what it is. But point being is we have, as I said before, that pipeline of properties that are ready to be bought. And they're all kind of the same type of strategy. You know, net lease real estate, necessity, necessity retail. You know, people always talk about, well, .com is going to shut down all the bricks and mortar stores. .com accounts for about 5.5% of all the retail that's going on in this country. It's getting to be bigger and bigger and bigger. But if you go to the doctor prescribes you some form of medication, of which, including myself, you know, about 75% of the people in this country have some monthly prescription that they get filled. And as they get a little bit further on in life, that number of, I think it's something like, I thought it was people over age 60, it was 70% of them have 2 prescriptions or more. So, you know, we're a very medicated society, whether we like it or not. Good, bad, or otherwise, you're going to go to the Walgreens, you're going to go to the Walmart to buy your prescription, you're going to go to Target, wherever you get your prescription filled. And then Walgreens, by the way, they have overpriced milk and butter and everything else you think you might need at the, you know, spur of the moment. It's a convenience store. So their business model is not going anywhere. CVS, you know, whatever it is. Anybody in here have their basement flood this spring with all the fun rain that we had? If you had your basement flood, I'm guessing you didn't go on Amazon to buy a sump pump or a shop vac. You know, you went to Menards or Home Depot or whatever it is, and you got a new sump pump and you got a shop vac. So, yeah, right, exactly. First thing in the morning, right? So that is the definition of necessity retail. You know, that type of thing is not going to go anywhere anytime soon. In the office and industrial, this may be the place where if you want to bet on the you know, the what I'm going to call it, .com type commerce to be a bigger part of the future. You know, what we're going to invest in, this just does a good job side by side of explaining what we're not going to buy on the left and what we are going to buy on your right. And I'll give these the guys in the back. You know, on the left it talks about a shorter lease, and give you guys one of those. I can grab you one afterward. The left talks about, you know, shorter lease, gross lease type of a property. You know, there you have 3 to 7 year leases from some. None of the tenants are investment grade. You know, they're smaller. You know, I call it mom and pop type of a tenant. Good tenants, but they just don't have the credit worthiness of a big, you know, Cargill or something like that that's going to take a whole building. And by the way, if you're the landlord on a gross lease property as an office building, you fix the elevator, you pay for the security guard, you fix the parking lot, and on and on and on. And some companies are very good at that. Cole does not, that's just not what we do. There are other companies that are great at that. Cole actually has a building that's a multiple tenant building down in Phoenix where our home office is. It's an 11-story building, and I think we have 6 of the 11 stories. And Heinz, another big office owner, that is the landlord. They do a great job. It's a beautiful office. We want nothing to do with fixing the elevator and the cafeteria and the parking lot and all that stuff. That's their deal. So we're going to look more to what you see on the right, which is a couple of the companies that we have. Keurig, I think I saw a Keurig coffee maker out in the lobby there. We own Keurig's research and design building, essentially their home office outside Boston. So every coffee maker that Keurig designs and puts on the shelf at Target or Walmart or online for the next 14 years, which is the duration of the lease, is going to start in that building. So something that I have a Keurig coffee maker at home. My wife doesn't drink coffee. I do. It doesn't make sense for us to, for me, my liver, to boil a full, to make a full pot of coffee every day. So it's just one of those little K-cups. And I see them in all kinds of offices that I go into every day. You know, there's, as I said, Amazon. You know, one of the biggest retailers in the world is doing this through their warehouse. So they're more of an online type of a shop, you know. The Subaru, anybody in here drive a Subaru? You know, we own Subaru's distribution center for all their parts. It's outside of Indianapolis in Lebanon, Indiana. Every part that gets distributed throughout the country goes through that distribution center. So if you're, you know, you need new, whatever it is, brakes or the blinker or whatever on your car, it's going to come out of that. It's going to come out of that distribution center. So those are the types of things that we own for the big Fortune 500 type tenants. necessity retail or office, they're both the same thing, long-term leases with durable income. So, and again, this is just one piece of commercial real estate. This is not the only, the end-all to commercial real estate, but we like to, think of it as the place to start, the core, the foundation of commercial real estate. And if you want to buy hotels or apartments or, other office properties that are out there, there's a place for it. It's just a different type of structure. So I'll stop there. It looks like some people are getting ready to get out of here. If you have any questions, let me know. I'll be around for a few minutes. So thanks on behalf of Sean and Nate and everybody here. Thank you very much for taking the time to come out today. You bet.
Okay, I'm curious about something else.
Yeah.